Dan Mitchell, senior fellow at the Cato Institute, joins us from Washington, D.C. Dan, good to have you back on the program. You know, it looks like we've been waiting for this. The market priced it in, but still, you know, the announcement on Friday night really sent shockwaves around the world. What do you think?
Well, it's a good wake-up call for the politicians in Washington, which have been borrowing and taxing and spending America into a fiscal ditch. And the key thing, and this is where I disagree with Geithner, who wants us to believe that this wasn't merited. I don't think S&P was looking so much at our deficit or our debt. What they were looking at is our unfunded liabilities, more than $100 trillion of promised spending on entitlement programs in the future. We don't have that money. That's where America is in trouble. We could grow out of the deficit and the debt. It's these entitlement programs that are going to kill us, and that's what people in the markets have to pay attention to.
So, Dan, you don't think there's any flaws in the S&P methodology to downgrade, I guess, U.S. debt, considering they missed out about $2 trillion in terms of their calculations?
This is a very subjective thing, and whether S&P does it one way, the federal government says they should do it another way, maybe Moody's does it another way. All we really need to understand is that there's a giant national debt, $10 trillion roughly of publicly held debt, $14 trillion overall. But again, it's that $100 trillion plus unfunded liability for the entitlement programs. That, I assume, is what S&P was looking at, and that's what Moody's and Fitch and the others should look at, because that's the real danger. America will become Greece if something isn't done to reform those programs, and we've already seen that Obama is showing no flexibility, no reasonableness, no compromise on these entitlement programs, and those are the killers for the U.S. fiscal situation.
Dan, let's talk about the reaction from Obama and the White House, because instead of addressing S&P's concerns in terms of why they downgraded the economy, it looks like they're criticizing S&P themselves. What about this strategy coming from the White House?
Well, the White House has two things they're trying to do. Number one, they're saying, well, S&P didn't get it right. But then they're saying, oh, it's the fault of those bad Republicans over there because they wouldn't agree to a tax increase. Well, of course, we've seen in Europe that they tax, then they spend, then they tax again, then they spend again, and it hasn't stopped them from rolling up these giant deficits and debt and getting into the kind of situation we see in Greece and Portugal. So Obama wants to use this as an excuse to try to lure Republicans into a tax increase trap, but I think that would simply result in more spending, economic weakness, and probably higher deficits.
And Dan, some are thinking, you know, why does Standard & Poor's go ahead with this downgrade, knowing what kind of panic it would cause in the markets?
If I had to guess, I think the panic will be short-lived. I think I agree with some of your other guests who have said that there's really no place for anybody to go. You're not going to invest in European government bonds. Japan has some long-run issues. So in some sense, the U.S. is benefiting from the fact that other countries have made similar mistakes in letting government get too large and spending so much. But that doesn't save us, because in the long run, we still have those issues of the huge unfunded liability, the weaker growth. We're getting European-style growth because we have European-style policies now.
Okay, well, let's talk about some of these European countries, because we have France and the UK also still AAA rated. Some are saying, well, why downgrade the U.S. when you take a look at the problems in France? You know, why don't you make a move, S&P, on what's happening over in the Eurozone?
Well, those are very good questions. I'm not overly optimistic. The Bank for International Settlements put out a paper last year where it looked at the long-run debt situation going out to 2040, 2050 for all the big European economies, the U.S., Japan, and basically we're all in deep trouble. It's only a tiny handful of countries, such as Australia and Switzerland, that seem to have more stable long-run finances, but if you're looking at much of the Western world, it's overtaxing, overspending, overborrowing. These are countries, including the U.S., that are headed into a fiscal ditch, and there's really very little optimism of how to get out, because we have politicians like Obama who are refusing to address the only real issue, which is the growth of the entitlement programs.
Well, you know, we have the U.S. borrowing 40 cents for every dollar that it spends. That's pretty dramatic in terms of numbers that we're looking at. So in the end, what does this downgrade mean for the U.S. economy? Does it help? Does it bring people together, politicians, I mean?
it might force the political class, the political elite in Washington, to finally take seriously some of the ideas, like Congressman Paul Ryan's budget. The only group that I think deserves some cheers are the House Republicans, because they passed the Ryan budget that would have saved long-term spending, saved $4 trillion. Then they passed cut, cap, and balance. The Senate Democrats have done nothing. Obama's done nothing. And let's be bipartisan about this. Bush helped get us in this mess because he was a big spender as well.
All right, Dan, thank you for sharing your thoughts this morning. Dan Mitchell, Senior Fellow at the Cato Institute, joining us from Washington. We have Nick Maroutsos, Managing Director and founder of Kapstream Capital, where he helps to oversee close to $4 billion in assets. Nick, thanks for joining us this morning. What kind of Monday do you think will be on the markets?
Look, I think we're in for another stomach-churning week, given the events of what happened. Obviously, the S&P downgrade is the headline of the day, or headline of the year, if you will. But you also have the FOMC coming in later this week, who will probably give some more guidance on the downgrade and potentially some sort of information on QE3. But ultimately, I think from what's going on currently in the markets, you're going to see stocks down, U.S. dollar down, and some buying in bonds, most notably in bonds in regions where monetary policy and fiscal policy is quite prudent.
Yeah, we have U.S. futures down over 2%, so expect a big sell-off again on Wall Street. Are you surprised by this reaction? Because, I thought from a lot of investors' points of view that this was already priced into the market.
Look, I think people can say that an event like this is priced in, but an event of this magnitude, there's no way it can be fully priced into the market. This is a life-changing event in many people's respects, because nobody has ever seen the U.S. have a AA rated status. So, we're going to see a lot of volatility this week. You'll probably see stocks gyrate up and down. Ultimately, any sort of bond selling will probably be met with buying, particularly because you have a U.S. environment that consumer confidence is very fragile, businesses aren't hiring, economic conditions are very slow, and let's face it, people aren't buying treasuries because they're rated AAA. They're buying treasuries because they're treasuries. It's not an issue of credit risk. So any sort of sell-off, we believe, will be met with buying. You will see people probably move some money offshore into other countries like Australia, like Canada, where policy is a little bit better. But to be perfectly honest, the bond markets aren't as deep enough to handle any sort of volume, and the next biggest alternatives are Japan and Italy, which are fraught with tons of issues.
Yeah, isn't it ironic then when markets are manic, people run to the safety of treasuries, hence we have yields at record lows. So, okay, so you're basically saying, correct me if I'm wrong, that we'll see selling, but the selling will end at some point with people looking to buy in.
Yeah, I think the knee-jerk reaction will be that the U.S. is downgraded. People are going to demand higher yields because of that downgrade. But because of the economic conditions in the U.S. are so bad, we look at it as a buying opportunity, because we don't feel that U.S. rates are at a level where the Fed's going to be increasing interest rates, or that there is growth to sort of demand a higher yield. Like I said, people will be moving some of their money offshore, and ultimately I think that the U.S. dollar is going to be the most vulnerable out of this, because there's really no way for the U.S. to get out of this problem.
Nick, I got 30 seconds here. Let's quickly talk about basically double dip and whether or not we're going to see QE3 quickly.
I think the likelihood of QE3 is coming on fast. The U.S. needs to act quickly and sort of implement some measures to sort of establish some sort of growth. Whether it's QE3, I don't know if they're going to call it that, but ultimately we'll see some further action.
All right, Nick, I'm out of time, but thank you so much for sharing your views. Nick Maroutsos of Kapstream Capital.